welcome back, and thanks for staying with us. We were talking about taxes and how we can keep more money in our family's pocket than giving it to Uncle Sam's. What's the difference? I think a lot of people get confused of what a CPA does, a regular, an accountant, compared to a tax planner, which of course is something that you all do.
Yeah. The accountant and the CPA, their objective is, when you're driving a car, is to be looking in the rearview mirror, right? They look at the last year and they say, how can we minimize your tax today? And that is a great strategy. And obviously, if the goal is to pay as little tax as possible over your lifetime, we do need to look at today. The problem is that sometimes they have short-term vision, right? They're only looking maybe one block ahead. Our goal when we look at taxes is to really look at from here to your final destination.
Way forward. How
do we pay the smallest amount of tax possible? And, you know, the CPA's job is to lower it today, and you feel good when you don't have to write Uncle Sam the check.
Right.
And so we like to work with the CPAs. Obviously, they are a tax expert. We never want to, say that we are something that we are not, right? CPAs have a job to do.
Everyone still needs a CPA.
They have to have one. So we want to work with them and we want to partner with them to say, what pieces of it do we want to address short term versus what pieces should we always have our eye on for the overall plan?
5 years, 10 years, 20 years.
Exactly.
Okay, and what are some of those strategies?
Well, obviously, in the process of helping a client understand how to pay the least, I think the maybe most significant one that we've found recently is one of the analysis that anyone that calls in is going to get, and that is the tax burden analysis. And I think what's so significant about that is that we know nobody wants to write a check of any size, and certainly they don't want to write it any sooner than they have to.
Right.
And we've told the story before, but I think it bodes telling again, and that is, if you've got an individual who's sitting on a big pile of money in a qualified account or multiple qualified accounts, because congratulations, they've done a great job, they saved, they were diligent, they kicked the can down the road.
Yeah.
And so now part of our planning is to help them understand, does it make more sense to pay the taxes over the next few years and get it done, have that money in an account that is 100% now yours, not a joint account with the IRS? Because frankly, qualified accounts are joint accounts. It's not just yours.
With the IRS.
It's a joint account with the IRS.
So whenever we see the word qualified, that means still need to pay taxes on.
That's exactly what it means.
I mean, non-qualified means you've paid it.
That's
and so
exactly
your goal
right.
is to get your money in a non-qualified way.
That's exactly right. So in this tax burden analysis, we will actually look at the total amount of assets that you have in those qualified accounts and do a calculation. Let's just say for a moment that it's $500,000. And in that $500,000, you're thinking, all right, I'm 60 years old. I don't need to take a dime until I'm 72, because it used to be 70 and a half, and now it's 72 because the IRS did you a favor. No, they're actually letting it grow bigger so you can pay them more. Don't be fooled. But anyway, you're going to now, instead of waiting and taking that money from 60 to 72 and taking it then, we're gonna look at doing a Roth conversion over the next 5 years. So on that $500,000, let's take $100,000 a year. Let's assume you're in the 25% bracket, so we're going to pay $25,000 each year for 5 years. Painful.
Right.
Payable to, $25,000, terrible. Okay. But here's the thing. This tax burden analysis will state very, very clearly that at the end of from 72 to 90, sorry, this analysis kicks you off at 90. At the end of that 18-year period of time, you took the money out. Remember, you probably didn't need it anyway, so you've reinvested in another account that was also taxable. It calculates all the tax on the distribution, the reinvestment, the compounding, and there's still a tax at death. That account is, you're not getting out alive.
I was going to say, we've never really talked about
We have never talked about that. That's
and that
right.
affects your heirs.
Any money that's still in that account is still subject to taxation. So here's the deal. $500,000 payable over 5 years in a converted Roth strategy is $125,000 in taxes. That's brutal.
Right. But
The 72 to 90 was over $400,000.
isn't that amazing?
$400,000. So if you want your tax burden analysis and you want to know exactly whether it makes more sense to rip off the Band-Aid or death by 1,000 paper cuts, call the number on your screen, 855-348-3073. We are more than happy to run that analysis for you, to have a conversation with you, to do all of the things that are included in that retirement roadmap. Give us a call so that we can help you understand exactly what the tax burden really looks like. It's not about what you pay today, it's what you pay over your lifetime. Don't you want to pay the least you have to?
We can all agree on that. Have your calendar ready for us, if you don't mind, when you call, so we can definitely get you a reserved spot. We save about 20 spots each week to make sure our viewers who are joining us get to speak to Karen and Samantha. And we'll have more right after this.